Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Elkan, and we're joined by Sean Emory. He's a Senior Investment Analyst at GFG Capital, as well as the author of themarketmeter.com. Sean, thanks for joining us this morning.
No, thank you. How's everybody doing?
We are doing great over here. We're just looking at the end of earnings season, getting in some retail stocks. What's been your take on this earnings season?
Yeah, no, that's a good place to start. So really one of the principles of investing is understanding that equity prices follow earnings over long periods. So it's definitely timely that earnings season is coming to an end. 90% of companies are done reporting. There's some pretty clear divergences in earnings among sectors. Everyone loves to talk about rates, and that's kind of the thing to do these days, higher or lower by September. It's kind of like roulette in Vegas, red or black. We kind of know how that ends. But back to earnings, there's actually a pretty big divergence among sectors. And if you look at the past rate hike cycles, I can talk a little bit about that. But one of the interesting takeaways from this earnings season is top line. So we have about 49% of companies in the U.S. which beat sales estimates. That's actually near the bottom of the historical range here in the U.S. The median over the last 6 years or so is right around 60%. So even with falling estimates over the last several months, companies really fail to meet these estimates. If you look at the headline numbers, the overall surprise on the earnings side and sales side are positive. But as an entire group, sales and earnings are both negative at negative 3% on earnings, negative 5% on sales. So not so rosy on the headline numbers, stripping out some of the noise like energy, which is pretty cyclical and actually makes up only 7% of the index. When I start to strip that out, we're talking about 4% earnings growth and flat on the sales side. So it's not as bad when you take out some of the cyclical parts. I'd say sales is concerning, though, especially as we move through a potential rate hike cycle. If you look at the last three tightening cycles, 2004, 1999, 1997, we saw revenue growth of 10%, 10%, and 3%. And on top of that, double-digit earnings growth. So far different from today as we head into potentially that cycle. We know what the drivers of the negative sales are, but everything outside of kind of the commodity sectors are pretty fine this earnings season.
Jumping out of earnings season, you mentioned looking at previous Fed rate hike cycles. What's your kind of outlook for our current rate hike cycle? Do you think we're going to get a rate hike as soon as next month or even at all this year?
Right, yeah. So the market's flipping a coin for September and even for kind of October and so on. I guess the view on rates is, look, we've never been at this level. If you look historically, we've been higher than this level every period, and GDP and economic growth has been pretty robust at some points and also pretty weak at some points. So it kind of, in my view, our view, it really comes down to just getting off the lower band, having some flexibility into the future. To say it's September or the day, again, it's kind of like playing red or black. But I think it does make sense to come off these lower bounds.
You mentioned you're also looking at the sector technicals to gauge the S&P 500, technology, discretionary financials, and healthcare making up 65% of the index, and therefore if these are healthy, there's a decent chance the market will be too. Can you kind of expand on this for our audience?
Yes, I like to take a sum of the parts analysis on the market, breaking down what really makes up the S&P. So you mentioned 65% are kind of in those financials, healthcare, discretionary, and tech. Mostly right now, fundamentalists, or mostly in general, fundamentalists and technicians tend to disagree on some things. But right now, if you look at the market, it's at a standstill. Supply and demand are pretty much at an equilibrium. But if you look at earnings and sales, they're also at a standstill. So it kind of makes sense if you look at it like that. Yesterday we had the S&P, or this morning, it's sitting right at that 2100 level, just north of the 100-day moving average and 50-day moving average, an area we've really spent the last several months. If you start looking at those individual sectors, so starting with tech, the anchor of the market, it makes up 20% of the index. Fundamentally, it has 3.7% sales growth, 4.7% earnings growth. From a technical perspective, the sector is trading very similar to the S&P 500, with the moving averages pretty much converging. It's riding the 200-day right now. We're above those September highs and July lows. So technically, it looks as it's very similar to the S&P 500, big anchor, big weight. So looking at that is pretty important on a forward-looking basis. One important thing to consider also, and I wrote about it yesterday, is that the tech sector has the largest buyback yield. So it's not technical. This is just the shares bought back as a percent of shares outstanding. And it also has the most cash as a percent of debt. So these things are supportive really to the largest sector, and I actually compare it to the Fed buying treasuries, as these companies are simply just buying back their shares, the largest component of the market. So that's pretty healthy. If you look at financials, XLF, sitting above those December highs after breaking out of an ascending triangle. This sector looks pretty fine technically. Fundamentally, we saw some positive sales growth, earnings growth, trading at 1.4 times book. That's 50% less than the market. And this is the second biggest sector of the index, and it looks pretty healthy both fundamentally and technically. So that makes two of the top largest components. Then we break it down to kind of discretionary sector. That looks similar to financials. It's sitting above a key support level. It's traded in a pretty narrow range if you look at the chart from February to about June before making an attempt and move higher. From a earnings standpoint, earnings were strong at 7%. Sales were strong, or fairly strong at 1.6%. And similar to tech, the discretionary sector has a large buyback yield. So it's the fourth largest sector in the index, but second largest buyback committed in kind of dollar terms. And then last one is healthcare. It's ripped for some time now and really has been the leader. It's running along kind of a short-term trend from those December lows. This level needs to hold. Fundamentally, it's performing at a high level. It's seeing 8% sales growth, 13% earnings growth. And here's the crazy part, really. Healthcare's growth rates outpace other sectors, and healthcare is leading other sectors in returns over the last year. So it's really that healthcare has been the strength. But if you look at the top three sectors, they look pretty strong. And looking at a sum of the parts, 65% suggests that the market's pretty healthy to me.
Would you say healthcare is the strongest sector, or if not, what do you think are like the top two or three strongest sectors in your opinion right now?
So I think tech has that fundamental backing
Yeah.
in terms of the buyback yield and also the debt to cash or cash to debt. So you have technically, you can see financials and discretionary looking okay on a technical standpoint, but fundamentally, tech looks like the strongest. And again, that's the anchor of the market. I think there's that buyback yield and also just the cash and what they do with the cash is going to be really supportive for the top end of the market.
You also mentioned that you wanted to talk about risks in the market, and we talk about risk management a lot on the show. So, what are some sectors that people can look at maybe to hedge out the risk?
Yeah, so if someone was scared, like you're saying, or wanted to hedge out some risk, it only makes sense to go towards some safe haven segments of the market. So that's bonds and utilities. If you look at the charts, both are sitting at key levels. PLT, or the 20-plus year Treasury, is sitting above that 124.50 level. This is the June highs, the October highs. Momentum in that space is pretty strong, even though what you think about rates, if they're rising over the long term. But in the short term, anything can happen, and the long bond looks pretty strong if we're looking at PLT. Historically, this would be a hedge to economic weakness. This would be kind of a view on no-go in September, and don't see any real reason for that relationship to change. Utilities, same thing. It's breaking above some key levels. The sector's still down year to date, and momentum has actually been picking up since about early July. And again, that looks pretty strong as recently it's moved above its 200-day and also a pretty key level. So these are really kind of two ways an investor can buy strength in historically less risky parts of the market.
What about globally? There's been a lot of, macroeconomic action over the past couple of months. Do you think investors should be concerned or following any of this? Especially, China, of course, had the enormous drop in their stocks the past day, and that's kind of affecting European indices, and we saw it a little bit affecting in the Wall Street's futures this morning. What's your take on that?
Yeah, so China's the runaway story for the last month, 2 months, for good reasons, right? It's one of the biggest economies in the world, but it's also one of the fastest growing in terms of consumer health. The way we look at it, specifically, we try to put our long-term lens on, look at how the manufacturing sector is becoming less and less part of the economy. That transition is feeding into the service part of the economy, which now makes up a larger portion of the Chinese economy. If you look at things like e-commerce and online sales, they're growing robustly at 30-40% year over year. If you look at the property market and looking at housing prices, which is one of the big concerns, that is starting to flatten out, which is really important for kind of the risks that they have there. Their corporate debt as a percent of a GDP is north of 200%. That's a real concern. A lot of those businesses are partially state-owned enterprises, so you can say, are these corporates or is this government? If it's government, then, which our view is a lot of it is, then you have the government backing. If not, then you have some serious risks. Either way, it's risky, but the thing that we like to focus on is the consumer, and seeing that transition and reform occur. And we think those different metrics like retail sales, online retail sales, are robust enough to keep us interested in some of those segments.
We're on the line with Sean Emory. He's a portfolio manager at GFG Capital and author of themarketmeter.com. Sean, I'm looking at your site here, and you said the foundation from your investing stems from the sport of baseball. Could you explain that to us?
Okay, yeah. So haven't talked about baseball and finance at the same time in a while, but the baseball is a sport where you have a lot of, I guess, call it stress. Every day you're fighting against not hitting 300. I mean, the benchmark in baseball is hit 300. That means you fail 70% of the time. In the markets, it's not about necessarily being the best in terms of getting everything right at 100% of the time, but it's making money on your investments. But during that time, there's a lot of stressful periods, and that really translates to investing baseball. The stress that of failing 7 out of 10 times to be good has translated kind of the finance world. As you continue to look for opportunities, things fall through, and you bounce back and keep chugging along and trying to crack and hit 50 or 60% of the time. But again, it's about making the money and protecting your downside. So there's from a mental and psychological standpoint, that's really where the cross comes. So that's really what I learned from baseball is managing stress and continuing to chug along.
Okay, and you're also currently the author of themarketmeter.com, and so tell us what an investor or trader would go to your site. What kind of information do you have available? Yeah,
so it's a site where try to provide as much kind of institutional type of research to the everyday investor. It's very hard to get access to some of whether it's the data that I'm able to accumulate or some of the ideas. The average person is not sitting at home looking at thousands of charts and all these different pieces of data, and I like to kind of regurgitate that into easy-to-read pieces on the market meter. And daily, you get the daily market meter update, which I talk about that single day. And then in addition to that, you get a weekly piece where I just talk about how I see the markets on that week and longer term fundamental ideas, but also technicals too.
All right, and just finally here, what a trading range we've been in here for a majority of the year. Not much could really shake us out of it. We had the Greek debt crisis. We have the fear of higher interest rates. A lot of different dynamics going to market, but we can't get out of this trading range. What do you think is going to be the driver? Either to send us back new all-time highs or break out to the upside, or finally break out of the bottom of this long-term trading range?
I think we're going to move higher. I think if you had to look at the higher probability move, I think it's to the upside. As we sit here, you have to understand that over the last 11 months, we've really gone nowhere. Earnings haven't gone much either, but for different industries, they have and sectors. And as we just sit here and kind of turn our tires, those valuations are lowering. And in addition, I think just getting the uncertainty of rate hikes out of the way, even if it's 25 basis points, which I don't think it has any effect on the markets, I think psychologically that's going to do a lot for investors and we'll be able to propel higher and actually move out of this range. And I think this kind of economic cycle continues to persist, and we're just an elongated cycle, and that's healthy for stocks.
All right, we've been on the line with Sean Emory, portfolio manager at GFG Capital and author of themarketmeter.com. I guess you're giving us a pretty decided bullish outlook on the market. Thanks a lot for joining us, Sean. We'll talk to you again soon.
Perfect. Have a good one, guys.